Well, good morning, Jagender Rana here. Let us discuss the new product today that is called Fire Loss of Profit Insurance. Fire Loss of Profit Insurance. See, two conditions for fire loss of profit policy are there. First of all, there has to be a fire insurance policy, that is material damage policy, in existence. It could be standard fire and special peril policy or the भारत सूक्ष्म उद्यम सुरक्षा पॉलिसी or Bharat Laghu Udyam Suraksha policy. So that policy is known as the material damage policy. And secondly, if claim is paid under the fire policy, then only the claim will trigger under the FLOP policy. So these two preconditions are important. This policy has three names: business interruption insurance, consequential loss insurance, and loss of profit insurance. Loss of profit is applicable when it is issued with the fire, and then it becomes the FLOP. And if it is issued with the machinery loss of profit policy, in that case it becomes the MLOP. There are many ways to sell it, like if a customer is taking the industrial all-risk policy for corporate sector, in that case the FLOP section is included in that only. Another one is if any fire policy is issued to any factories, SMEs or commercial institutions, like standard fire and special peril policy or the Bharat Sukshma Udyam Suraksha policy or Bharat Laghu Udyam Suraksha policy. In that case also it can be given. Third is if there is any package policy by any insurance company, like the companies have business protector policy also. So with them also it can be given. And the last method is the package policies which are having the inbuilt section of FLOP. Then the customer has got a choice that one more section of FLOP can be selected with the basic fire coverage. So these are the four ways to sell it. For shopkeeper insurance, their insurance companies can apply their guidelines. They can restrict the sum insured, they can restrict the indemnity period, and even premiums. So as far as the FLOP definition is concerned, this policy covers financial losses of the risk due to interruption in business following a loss or damage to insured property covered under material damage policy, that is fire and special peril policy. There is a block-wise separate sum insured for building, plant and machinery and accessories, stocks, furniture, fixture and fittings and other contents. The purpose of a FLOP policy is to protect the insured against loss of income or profit only. Profit only. So FLOP policy can be insured. The proposer must have a fire policy with the insurance company, and it should be enforced. That is, standalone policy is not allowed. Proposer's business must continue. Proposers should be earning income or profit. This is the case of the net profit and net loss, where the gross profit is more than the fixed cost and standard charges. The remaining portion is called net profit. And where fixed cost and standard charges are higher than the gross profit, this is a case of net loss. So gross profit stands for standard charges plus net profit, while the gross profit is equal to standard charges plus net loss. So difference between a fire policy and FLOP policy is that fire policy is a material damage policy because this provides cover against physical damage to assets but does not cover the consequential loss. While FLOP policy means this provides cover against loss of gross profit following operations of insured peril or increased cost of working. As far as understanding the flow of events is concerned, See, material damage policy has to be there, then there is a loss indemnifiable under the policy, and then interruption in production process must be there. That will result into the reduction of sales turnover, and that will ultimately result into the loss of gross profit. So as far as sum insured of this policy is concerned, it should represent annual anticipated gross profit duly adjusted as per the trend of the business. Policy period means the annual period during which the company bears the risk. It could be normal policy period like from 1st January to 31st December. Indemnity period is special because it represents the insured estimation of the maximum period required for normal business operations to be restored following a loss. That should be mentioned in the months like 3 months, 6 months, etc. This is the case of indemnity period. Say January 1st to 31st December, there is a policy inception date, and 31st December is the expiry date. This is policy period. Now, say suppose on March 1st, that is date of loss, the interruption period starts up to February 15. And then on February 15, business comes back to the full steam. So case 1 is longer indemnity period of 15 months, case 2 is lower indemnity period of 9 months. This is the case of indemnity period. Now key terms are interruption period. Actual period of interruption is starting from the date of loss, that is damage till the date normal operations has been restored. It can be more or less than the chosen indemnity period, but insurance liability is restricted to lower of the two. So this is the case of the interruption period. It is a period which starts from the rate of loss and ends with when the business achieves the same production level where it was prior to a loss at insured premises. So production starts, and then the loss date, and when the production restarts, and what is the recovery period. This all is covered under the interruption period. Certain other key terms are important like standing expenses. So fixed expenses which continue to occur irrespective of production levels. Examples are insurance premium, rent of building, salary, dividend, interest on loan, administrative cost, vehicle rent. They all are covered under the standing expenses. On the contrary, there are variable expenses. These varies with the production levels. No cost incurred when no production. Examples are cost of raw material, freight inward, electricity, labor cost, etc. So rate of gross profit can be worked out. Rate of gross profit earned on the turnover during the financial year immediately before the date of the damage. Rate of gross profit means gross profit upon turnover. Say for example, turnover closing stock is 10 lakh, closing stock is 20,000, so total is 10 lakh 20,000. While opening stock is 20,000, purchase is 3 lakh 50,000, so total is 370,000. So in the above example, the gross profit is 6 lakh 50,000 and rate of gross profit is 60%, 65%. So that is the way how the rate of gross profit is worked out. Now let us see what is gross profit. At the amount by which the sales turnover exceeds the manufacturing cost. Means sales turnover minus manufacturing cost is equal to gross profit. So gross profit includes standing charges, net profit, increase in cost of working. Question is how to decide on policy sum insured. For policies with 12 months indemnity period or less, sum insured should be annual gross profit. For policies with indemnity period more than 12 months, say for 18 months, the sum insured will become 1.5 times. For 24 months, it will be doubled. For 30 months, it will be 2.5 times, and so on. And FLOP perils or perils covered under the material damage policy are also covered under the FLOP policy. It means FLOP policy triggers if claim is payable under the fire policy. And fire policy normally have the 14 perils today. In addition to the standard fire and special peril policy that has 12 perils. But in Bharat Sukshma Udyam Suraksha and Bharat Laghu Udyam Suraksha 14 perils are there. So certain add-on covers, if opted by the insured, they are also covered. Add-on covers could be as per the fire tariff, like deterioration of stocks, forest fire, impact damage, spontaneous combustion, omission to insure additional distance, earthquake, spoilage, material damage, leakage and contamination cover, temporary removal of stocks, terrorism, architect, surveyor and consulting engineer fees, removal of debris, loss of rent clause, additional expenses of rent for an alternate accommodation and startup expenses. Then comes the details required for underwriting. So following details are required to underwrite quotations for fire loss of profit policy, that is details of fire policy, basis of accounting, list of standing charges, indemnity period, gross profit, turnover, whether unit is continuous or non-continuous unit, and add-on cover if required. As far as compulsory access is concerned, policy excludes the compulsory access because the FLOP policy carries access in days. It's known as time access. Minimum time access is 7 days. The intention of access is to avoid dispatch losses and to take some share of loss in major claims beyond 7 days. Any restriction on reconstruction or operation imposed by any public authority is excluded. The lack of sufficient capital of funds with the insured or timely restoration or replacement of property lost, destroyed or damaged is also excluded. Another exclusions includes loss of business due to causes such as expansion, lapse or cancellation of a lease or license or orders. Then damage to boilers, economizers, turbines or other vessels, machinery or apparatus in which pressure is used. Other contents resulting from their explosion or rupture. Then electronic installations, computers and data processing equipments. Damage resulting from deliberate erasure, loss, distortion or corruption of information. Other erasure, loss, distortion or corruption of information on computer system or other records. Then mechanical or electrical breakdown or derangement of machinery or equipments. As far as add-on covers of FLOP policy are concerned, there are few add-on covers available, like accidental failure of public electricity or gas or water supply, damage to customers' premises due to perils covered under fire policy, damage to suppliers' premises due to perils covered under fire policy, and auditor's fee. These are the most important add-on covers. Certain other add-on covers may also be there with certain insurers. So the important question is that policy duration is 1 year. It's a short-term policy, can also be issued. The policy compensates the insured against the loss of gross profit in case of any accident caused because of the peril separated from the fire policy. So gross profit means sales minus cost of goods purchased. Deductibles are 7 days of gross profit. There may be decline categories because insurers have the decline category applicable to fire insurance policy. Same are applicable here also. Say for example, mobile shop, cracker shop, plastic manufacturing units, standard warehouse, shop dealing in hazardous goods. Normally this kind of businesses are excluded from the fire policy by the insurance companies because they are the incurring the high claims. Now certain examples can show how the premium will be calculated. Say for example, gross profit is 20 lakh, occupancy, engineering workshop, add-on cover, earthquake and terrorism, indemnity period is 3 months, earthquake zone is third. So how to calculate the premium? First we need to know what rate is taken for fire policy, that is say 0.75%. Then we need to add rate against earthquake and terrorism, and now we need to multiply this rate with the gross profit. Say suppose 20 lakh is the sum insured, 1.08 is the rate of premium, so the 2160 plus GST is the only premium. That is the way how this premium is calculated. Similar is the case with the claims. So if customer is having fire policy with other insurer, can we share FLOP policy? Normally We can sell FLOP policy subject to condition that the insured has to provide other insurers fire policy with us. Thank you. Thank you very much.